Good morning and welcome everyone to the Moneycontrol live stream. You're watching Markets with Santo and CJ. Well, after the best week in nearly 3 months last week, we are going to start this new week on a very lackluster note. If you look at the Nifty futures on the Singapore exchange, they are indicating a weak opening for the Indian market. Well, the cues from the handover from the US market was quite muted because the Wall Street ended on a mixed note with Nasdaq and S&P ending lower while the Dow Jones probably ended higher. But it is the strong jobs report that came in on Friday evening that has got the bulls a little nervous. The better than expected numbers for the June month has now really brought back the conversation again to Fed rate hike of about 75 basis point in the upcoming meeting later this month. So bulls better buckle up because the entire bubble of, that probably Fed is going to, chill a little bit on the rate hike, Santo. It seems to be pricked by that economic data.
Well, and I think back home, CJ, the focus is likely to remain on IT stocks today.
Yeah.
With TCS numbers. I think the general reaction to it is that it's been a little short of expectations. And also, the other big risk for the market at this point, I would say, is the rupee. So far, the market has managed to hold on steady.
Yeah.
But I think if the pressure on the rupee continues, probably we could see.
Yeah, we had the dollar index at a 20-year high, clearly. So there is and with the Fed rate hike, conversation again turning averse for the bulls, clearly a surge, another upswing in dollar could end up being detrimental to the
Well,
rupee.
with that, let's quickly take a look at the stocks on our watch list this morning, starting with Metropolis Healthcare. Now, CJ, diagnostic stocks in general took a solid beating over the last 6 months. You've seen them fall about 50-60% from their peak.
Yeah.
But now, at some point, even in sectors where there is not much happening, probably there's some kind of value emerges, and probably that seems to be the case.
Oh, are you turning your game on Metropolis?
Yeah, Metropolis, and I'd been I just came across this interesting report by JM Financial. So these are the points it's making, for supporting that stock. So what JM says is that the big worry, the biggest concern has been the entry of deep pocket players, mainly established pharma companies and hospital chains. Now, two things here. One is that market is really overreacting, which tends to happen whenever there is competition afresh. Secondly, what the point that JM is making is that most of the new players, they're largely targeting the wellness segment, and if you look at all the listed players, they're not really so much into the wellness segment, and the kind of pricing pressure which market is fearing is most likely to come in the wellness segment and not so much in the specialized and radiology segments. Besides that, Metropolis discount to Lal Path, which is the market leader in this segment, that has widened considerably.
Absolutely.
So JM is now bullish on the stock with a price target of 1,760 rupees.
Well, Santo, I think in the past I also said that the margins concern over Metropolis were a little overblown, but that does not mean that there are no concerns on the margin front. Clearly, the upswing in competition that we are seeing in the diagnostic space, not only from the established players, the hospital chains that are getting into it, your Apollos and all, but you also have a lot of startups which are backed by private equity money that have been trying to make a dent into this market. And clearly, therefore, I think margins is going to be something that is going to remain in the conversation for a lot of investors when they look at a stock like Metropolis. And lastly, I think another fear of or factor of uncertainty is the possible inclusion or induction of a strategic investors. We don't know what is happening on that side. There were some rumors about the promoter exiting, but they have squashed those rumors about a month ago. But the conversations are ongoing. Street, what you hear on the street, they say possibly Flipkart is on the anvil, Amazon is on the anvil to try and take a stake. If they do patch up with a e-commerce name, then it could be great for business, because that is something where Metropolis is now lagging behind some of the other players out there. But clearly, the uncertainty on these two factors, the margins as well as the new investors, will continue to weigh on the stock. Well, the next stock on our list, is going to be the stock of the day, although DMart might have something to say about it, is TCS. Well, as Santo said in his intro, clearly the numbers were a little below expectations, but let's just be honest, the expectations were not that great also to start off with. But if I look at it, Santo, in a comparative basis, I just feel that, the fact that they have missed out on estimates, but the miss is not that great. It's not like a very surprisingly negative quarter wherein we have seen almost 10 to 15% below estimate numbers on the revenue or PAT front. Yes, growth has slowed down. Clearly, that is not a good news for a company like TCS. But I feel that a lot of this bad news regarding the first quarter was already priced in the stock. I mean, we know that IT sector as a whole has not had a great 6 months, and TCS was part of that bandwagon, right? Apart from that, now let's look at the the positives that have emerged. Now they have indicated that there could be a possible reversal in margin going ahead. Possibly, we have seen the peak pain in margins with a almost 230 to 240 basis point on your reduction in margins in Q1. Why the reversal could happen? A, of course, attrition is likely to moderate from going, from the second quarter onwards. That is the commentary that is coming from the TCS management. And of course, you have the positive tailwind from the depreciation in rupee. Yes, some of it will be offset by cross-currency, headwinds, but overall, you would expect a net positive effect on the margins of TCS going ahead. Apart from that, from my point of view, Santo, the commentary on deal momentum is clearly something that really stood out for me. They have suggested that the pipeline remained quite strong and the deal closure also remained quite strong. And so far, they have not really seen clients coming up to them and saying, oh, we probably don't want to go ahead with this, or we want to cut down the size of the deal that we have. So clearly, I think Q2 would be a better quarter to judge deal momentum, because traditionally Q1 has never been great for deal momentum. Yes, there has only been a 1% year-on-year growth in the order book of TCS, but I still remain quite optimistic that maybe the past barometers when recession is coming in the US and therefore you should just sell off IT stocks because deal momentum is going to slow down may not be applicable this time around, because this seems a different industry altogether.
Well, CJ, the big worry about TCS mainly is that the street is not really worried about FY23, and that the management has also indicated that the current year's pipeline is there's no concerns about that. Where the issues and where the market is fretting a little is visibility beyond FY23, which is FY24. The company said it sounded very cautious when it was guiding on that, and given the premium valuations that TCS has always commanded compared to other things, it was very much on the cards that market would look forward to something very reassuring. That reassurance probably is not what the market is getting at this point in time. There are fears of recession very clearly at this point, and most analysts who are bullish on the IT sector in general are still saying that, look, deal pipeline for this year is strong, but we are still, valuations are not pricing in a recession. What happens then? That is probably the big.
I think, Santo, I think just one point here, Santo. I think probably TCS management has been a little mature in not trying to peddle an optimistic narrative out there, because let's just be honest. I mean, the Q1 we have had was probably equivalent to almost 2 or 3 years of macroeconomic development, right? You had inflation going bonkers, you had crude oil going bonkers, you had almost a World War III situation at one point of time in Europe. So clearly, I think given those macro uncertainties, that is why I feel that probably the management has taken the more prudent step of not trying to jump the gun on FY24. I mean, let FY23 itself get over, right? We have not even gotten into this, we have just gotten into the second quarter of this financial year. So there is probably no point in them trying to jump the gun and trying to reassure investors about FY24, because you don't even know how that might be, right? Let's just wait out for the first half, and I think probably second half onwards they will be able to give a more clearer picture on where FY24 would be. So I think for investors, I mean the good investors probably, or the calmer investors out there, would actually appreciate the prudence that the management has exercised here. Also on the valuation front, yes, I can understand that there are likely to be earnings cut, but the earnings cut that I have so far seen from brokerages have not been beyond 2 to 3 and max 5%. So clearly the downsides to me seems quite limited, especially at a time when buybacks are still on the table. They've already concluded one buyback, and it is possible that by next year this time you could have another buyback happening.
Well, CJ, the third stock on our watch list today, Mahindra and Mahindra. I'd been mentioning this on Friday also. I've been bullish on this stock for quite some time, but now, with the company finally announcing the investment by British International Investments into its EV arm at a valuation of close to about $9 billion, which was not on the table so far, I think the stock may have peaked out for the time being, despite that huge.
Is it just because they have entered the EV space?
No, it is purely on technical factors, not so much on fundamental factors. Stock has seen a good run up now, but if you were to look at the technical side of it, which is a huge build-up of positions in the derivative segment. Futures also positions have increased considerably.
It's become a very crowded trade.
Yes,
Definitely.
everybody is onto it. Plus, there's a lot of call options having been written out around 1200 strike. So these two things put together, I think the stock may cool off for the time being. It's had a fantastic run, but we are not going to see that spectacular run, at least for the next few months.
Well, interesting take there, Santo. But I just feel that probably, with the EV inclusion, there could be some upside in the near term at least. Maybe not so much six months down the line, but at least there's at least some scope for a further re-rating in the valuation or valuation multiples, given that now a lot of investors, especially foreign investors who might be getting into M&M, would start looking at as an EV story along with an India consumption story. I think that is the only defense I would say in terms of the stock's performance going ahead. Well, the next stock on my radar is the DMart numbers. Well, great numbers for Q1, despite all the skepticism around the stock, despite all the the banter around its valuation. The company's performance for the first quarter was quite excellent, not only on a year-on-year basis. Of course, definitely the year ago base quarter was quite weak given the second wave, but even on a sequential basis, clearly the first quarter of no disruption in business activity has shown in the numbers. If you look at, for me, the one standout highlight of the entire performance was the margin front. I mean, clearly 10.3% EBITDA margin, which was almost 5% ahead of a lot of analyst expectations, that they were putting out for the first quarter. That goes to show that clearly the company, despite it being in an inflationary environment, is giving a good value proposition to a lot of mass consumers out there. So that is something to really watch out for. And lastly, I feel that given the fact that the stock has already fallen 16% so far this year, there is some emerging comfort around valuation, plus the fact that we have seen such a strong recovery. Q2 is going to be even better because there are unlikely to be any more disruption from COVID. So clearly, there is a potential for a good upside on the stock going ahead, in my point of view.
Well, all points taken, CJ. Just that I feel the spectacular performance that you're seeing, partly the year-on-year numbers, they've come off a very low base.
Absolutely,
right?
yeah.
That's one.
No doubt.
And secondly, again, it comes down to, yes, I take the point that they give good value for the DMart. Clearly offers a very good value for money proposition, which is why sometimes in an inflationary
every time I go, I only dread the fact that I have to stand in the queue for so long, man, while checking out.
And with that, we have the market opening, and no surprise really, in line with what the SGX Nifty was showing. Nifty is down about close to 75 points in early trade. 900 stocks down and 900 stocks up at this point.
Quite a tug of war between the bulls
at this point in time. Nifty Bank is down about 0.2%.
If you look at the broader market, Santo, the Nifty Mid Cap 100 is down about 0.5%, small cap about 0.2%. So clearly, again, small caps relatively outperforming at this point of time. We have mentioned it last week, small caps had a very, very good comeback, Santo, likely because valuation comfort at this point of time, if it is there, is possibly there in the small cap space, given the sort of decline that individual stocks on that side of the market have taken over the past 6 months.
2% down TCS in early trade. Overall, tech stocks are under a bit of pressure.
Clearly, at this point of time, I think it seems like IT is the one that is leading the losses at this point of time. We will have to wait and see whether those 2% probably incite some of the fence sitters on TCS to possibly do some bargain hunting. But at this point of time, things are looking a little weak on the market.
Well, yes, and coming back to Avenue Supermart, CJ, again, it's all about valuations. A lot of it has already been priced in. The market is still some way away from the record high it had made last year, October.
Absolutely.
And yes, the stock has already rallied 16% over the last week or so in anticipation of strong numbers. So probably.
But Santo is still down 16% for the year despite that sort of a rally. So that for me means that possibly investors are still lagging behind.
Yeah, and then on a different note, CJ, it's I mean, I can say this, that the valuations are expensive, but probably that may not be the best way to measure the value of a stock like the Avenue Supermart. The last stock on our watch list this morning is Dabur. Now, good set of Q1 update from the company, CJ. It's guiding for close to about high single-digit growth in its India business, and also mid-single-digit volume growth. Strong growth in both its food and beverage segment, double-digit growth there. Also, its home and personal care has grown by anywhere between high single digit to low double digit. At a consolidated level too, its international operations have done well, high single digit growth in terms of in constant currency. Of course, there has been a depreciation in the Turkish lira, which will hit overall consolidated revenues, but decent numbers, and you have seen a good run up in the stock over the last month or so, and I think this stock will be able to hold ground in this volatile market.
Well, Santo, what have we come to if we are being optimistic about high single-digit growths now in the market?
In an inflationary environment, CJ, that is no mean achievement, let me tell you that.
GDP is expected to go 15%. If a company is saying high single-digit, I would rather scoot away from that company in the
You're talking about an FMCG company here,
yeah,
CJ,
that is
not an IT company.
Let's come to the concern, Santo. I mean, okay, maybe they do have a high single-digit growth in in value terms or in revenue terms, but clearly a lot of it is going to be driven by value, not volumes, right? The questions about volume still remain in FY23 over Dabur and the rest of the FMCG pack as well. There was a lot of hope that rural revival will happen when the IMD forecast came for a very normal monsoon this year, but clearly monsoon so far has disappointed all across the board. Overall, it's still running in deficit, and if you look at certain patches or blocks in the country, a lot of areas are still in rainfall deficit in double digit and high double digits. So clearly for me, the monsoon has not panned out, and I think that remains to be a big risk factor going ahead for the volume story for a lot of FMCG companies, more so for Dabur India, which also probably will have a lot of exposure to the rural market. So for me, yes, maybe in the value terms, they might be able to get that high single digit, but nothing really in the stock for me to excite me in this market.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thank you for watching, and do share your feedback in the comment section below.
And as usual, guys, keep following us on the social media links at the bottom of your screen. And I don't need to say this again, keep following moneycontrol.com and download the Moneycontrol app for rest of your financial news. We'll catch you again live at 3 p.m. with all the day's action. Till then, hopefully you will have a great trading session.